Hello and welcome to this video. And in this particular video, we are going to look at the Finviz Screener settings for fundamental analysis in order to identify undervalued companies which are trading at a deep discount. So we are going to look at a screener which is going to bring up companies which are trading at a deep discount. That means as compared to their intrinsic value, they are right now trading at a much lower price and are fairly good investments if you want to get into them from a fundamental analysis point of view. So let's get started. A quick preview as to what all we will cover in today's video. We'll have a brief look at what fundamental analysis is all about. Then we will look at the two most important tools that I use in my fundamental analysis while deciding which companies are undervalued and which companies are actually bargains, and in order to filter out all the trash which is out there and make sure that I'm only picking up good companies. We'll go to the actual Finviz platform and we'll look at the screener settings in detail. We'll also see what companies get listed today in the output, and then we'll analyze some of those to see if they are actually undervalued companies or not. As I've mentioned in a lot of my other videos, that no screener itself is going to be a complete trading strategy. So whether it is RSI, whether it is technical charts, candlestick charts, everything has to be used in conjunction with the rest of the signals in order to form a complete comprehensive trading strategy. So here we'll again see how fundamental analysis gets combined with the rest of the things that are available in the trader's toolkit, and how we can build a comprehensive strategy without just using the fundamental analysis screener. And then finally, we'll look at some of the don'ts that traders and investors should avoid, in my opinion, so that you don't basically end up with something called analysis paralysis. So let's get started. Before we proceed, a quick look at the disclaimer. Whatever information I'm sharing with you is based on my experience, it's my personal opinion, and it's only for entertainment purposes. So please do not consider any of this as any kind of trading or investment advice. And I would request that you consult a certified financial advisor if you're planning to invest or trade. So, the first thing we want to understand what is fundamental analysis. Now, if you are into trading or investing, there are two basic main schools using which different types of analysis are carried out. So, the objective for any trader or investor is to make money, and the only way you make money is if you buy low and sell high. So, we basically want to identify companies or stocks which are trading at a discount or low values right now, and in future there is a pretty high probability of those stocks to go higher. And I'm using the word probability here because anybody who's trying to sell you the holy grail or give you 100% trading system is actually lying to you. There is no such thing because the markets are random. The net action in the market, whether a price goes up or down, is dependent on the decisions made individually by hundreds and thousands of traders and investors across the globe, and therefore it's just not possible for anyone to be accurate 100% of the time with regards to their estimate on whether the price is going to go up or not. But the two main schools of thought which help with some kind of analysis to improve our odds or probability of making the right estimate, the one school of thought which is called technical analysis, which basically believes that all the information about a particular company is already factored into the price. So only looking at the price movement, the technicians basically they try to evaluate what the company stock price is going to do in the future. So let's say if on the chart it's visible that every time the stock price goes to $50 for a stock, it bounces back up, then they'll call $50 as a pretty strong support, and then they'll expect the same behavior to be repeated in future, that if the price falls down to $50, then there is a pretty good chance of a bounce back from that price level. Fundamental analysis, on the other hand, is different. It basically analyzes the publicly available information about a company, and using that information, the fundamental analyst tries to decipher which companies are trading at a discount. So every company will have two values. One value is the market value or the stock price of the company at which the stock is actually trading in the market. So let's say we consider Apple, it's trading at around $150 right now. So that's the market price. That's the stock price. That's where the market is valuing Apple right now at this very moment. But let's say you did your analysis and you found that the intrinsic value of Apple is actually $220. So based on your calculations, you feel Apple should be priced at $220. So we can say it's trading at a discount. These are just numbers that I'm giving to help put across the concept. But so don't take these are not calculated numbers. So don't use them in any way. But the point I'm trying to put across is that the intrinsic value is the actual value that we feel, or the person analyzing the stock feels the stock should be trading at based on its current financial analysis. But the market value can be different from the intrinsic value. So if the market value is lesser than the intrinsic value, then those stocks are trading at a discount, and they basically provide a buying opportunity. Within fundamental analysis, you can carry out two different types of analysis. One is called qualitative analysis. In qualitative analysis, we basically deal with everything about a company besides any concrete numbers. So let's say we consider Apple. Now, Apple, if you think about it, is a very good brand, right? If you compare it to other mobile manufacturers, like some of the Chinese companies like Xiaomi, or any of the smaller companies like Oppo, then these are the you can clearly see the difference between the brand that Apple holds and the other brands which are out there in the market, right? So essentially, the qualitative analysis is going to look at these kind of things which you can't judge by pure numbers, but they are very significant in basically deciding where the company should be valued at. So brand itself has a lot of weightage. Brand itself has a lot of value. Think about Coca-Cola, which is a very well-established brand in almost the entire globe, and then compare it to a local brand which is just coming up, which nobody knows about, and is producing some kind of a soft drink. So Coca-Cola is obviously going to have a higher qualitative value as compared to any other generic brand, right? Then along with that, we look at the management. The management, again, you can't put a number to how good or bad the management is, but the experience of the management, the quality of the management, how well they have managed the companies in the past, what positions have they worked at in their past years of working, all that basically forms the qualitative analysis. Similarly, goodwill, innovation, and patents, these are the kind of things which will come under qualitative analysis. So when we analyze a company, we look at all these parameters to see what are the strengths and weaknesses for a company based on qualitative parameters. The second portion of fundamental analysis is about quantitative analysis, where we get into concrete numbers, and this is primarily based off the financial statements that are generated by the company. So every listed company has a requirement that it needs to publish its financial statements on a regular basis. So the financial statements give us a lot of figures, like how much sales is the company making, what is the growth rate of the sales, what are the returns that the company is getting on the investments that they are making, how much debt does it have. So all these different numbers can be churned into different ratios, and those ratios basically allow us to slice and dice the data in different ways and compare companies within the sector and across sectors as well. Quantitative analysis is basically making sense of these numbers. So the company which is producing the balance sheet is going to throw you the assets and liabilities and everything. But how do we make sense whether this is a good company? Is it being managed well or not? That interpretation is made by the fundamental analyst. I think fundamental analysis, the definition should be clear by now. So, mainly two schools of thought: technical analysis, which doesn't deal with any kind of numbers, it only deals with the price action and the charts; fundamental analysis, which deals with the financial statements and the overall outlook for the company based on their brand, their management, and the kind of financial results that they have been producing in the past. So, the two most important parameters that I use in fundamental analysis, I am going to explain these two in detail because, in my opinion, it is not very important that you use tons of ratios and tons of parameters. Use lesser number of parameters or fundamental tools, but you should understand what those numbers really mean. If you don't understand a number, my recommendation would be not to use it. Just because somebody is using a peg ratio, and if you don't really understand what a peg ratio actually means, what a high value is, what a low value is, then your analysis is going to get skewed, because these ratios or these numbers just don't have to be looked at in isolation. You have to know these numbers, what they mean in the background of the market situation. So the numbers will look very different for the same company when the markets are in a bull phase, as compared to when the markets are in a bear phase, as compared to when the markets are trending sideways. So that doesn't necessarily mean that the company fundamentally is a good company or a bad company in these different phases, right? But the numbers will show very different picture. So unless you understand those numbers and you can basically adjust those numbers according to the market conditions, you should not use those ratios. And you saw one of the points when we saw the preview in the slides, right, which I have mentioned is analysis paralysis. So the more data that you try to analyze, the more complex things become, and the lesser understanding the analyst actually has of what he's trying to decipher. Simple things make sense and they actually work. So one of the things that I use for my analysis is return on assets. Now, why is return on assets on the top priority list for me when I'm doing my fundamental analysis? The answer to that is very, very simple. So let's say if you want to invest your money, what will be your first question? Your first question is, what is going to be my return on this investment, right? So the return on investment is the first thing that we would want to know. Same way, when you invest your money in a company, when you're buying shares of a company, you're essentially investing money into that company, right? Now, I know that in the secondary market, you're buying shares from somebody else who's just selling it to you. But let's consider the IPO stage when the company is actually raising money. So they are giving out shares, and in return for those shares, people are investing their money with the company. So the first thing that you want to understand is, if I invest my money in a certain company, what return can I expect from this particular company? That return is measured by the parameter which is called return on assets. Assets are anything which a company owns. It includes cash, it includes inventories, it includes land, machinery, real estate, any kind of things that the company can use to run its operations and to generate earnings is basically called assets. So it's the return on assets is, if you think about it, is the basic thing that we want to understand about a certain company. So let's say I have two companies, X and Y, and one company has a return on assets of 10%, whereas there's another company which has a return on assets of 30%. So which company do you think is a better investment? Obviously, the company which has a higher return on assets is a better investment, because if I invest $100 into both these companies, the first company is going to generate a 10% return, that means $10 on that investment, whereas the other company is going to generate $30. So return on assets is basically one of the most important parameters that you need to look at. And another thing that I want to put across right away is that don't use too many parameters. Okay, if you try to use too many parameters, one of the things will happen. Either you will miss out on good companies, because some company may be having a real good value of ROA, but some other parameter, some other ratio that you're trying to use may not be good, and so you will actually miss out on good companies. And the second thing is, many times if you use too many parameters, the universe of stocks that you will get in the output of the screener will be so less in number that you will never be able to find ample opportunities, and so you will be stuck with very, very limited choices. Okay, so if you're just getting started with fundamental analysis, one of the parameters that you should definitely look at when making an investment decision is return on assets, because return on assets is one parameter which holistically will tell you that whatever assets, whatever money, inventory, and other things that a company has, how well is the management utilizing all of those assets. If the assets are underutilized, or if they are not utilized in a proper manner, then you should stay away from those companies. So if ROA, as if it is, I mean, as high as possible, the better the company is, because they are making very, very effective use of their assets. And secondly, companies with high ROAs, think about it. Some company raised $100 million from an IPO and they have a 50% ROA. That means next year, with their operations itself, they are going to generate $50 million. So initially they raised $100 million. Next year they have $50 million coming in straight away from their operations. So these kind of companies, number one, can expand a lot, they can grow a lot because they have so much cash to invest without taking too much leverage or debt. They don't have to go in for debt because they are internally generating a lot of money. They can grow very fast because their internal rate of return is very high. They can invest all that money back into their business, and once these companies reach a certain maturity, then they again return value to the shareholders because they have so much excess cash. They can either pay out dividends or they can initiate share buybacks. So when they pay out dividends, they are paying out returns to the investors. When they do the share buybacks, then the number of overall shares in the market is going down, and so the percentage value of the shares is going up. So return on assets is one of the parameters that you must look at when you're trying to make the investment decisions. The next one is price to earnings ratio. Now this is a very common parameter that you would have heard, but when you combine this with ROA, it becomes extremely powerful. And the reason for that is very simple. ROA is giving us companies which are well managed, which are making very, very effective utilization of the assets at hand. So we have already put in one filter which is giving us a set of good companies. Now I do want to buy into good companies, but I don't want to buy into good companies when they are expensive. The second rule is buy low and sell high. So even if a company is good, you need to be able to buy that company at a steep discount. You don't want to buy a good company at an expensive price. And this second parameter basically tells us that out of the good companies that we filtered based on ROA, which companies are relatively cheap. So price to earnings is telling us how expensive a company is right now as compared to its past and also as compared to its competitors. So you can track the P to E ratio for a company over the last 5 years. And if that P to E ratio is falling, then you know for some reason at this very moment this company is valued at a lesser price than where it was valued earlier. Also, P2E ratio, let's say you're looking at one company, let's say I'm trying to uh, analyze a certain company in the pharma sector. Then what I can do is I can pick up its competitors and I can see what the P2E value for the competitors is, and that gives me an idea that as compared to the competitors or as compared to the overall sector, is this company right now expensive or cheap. So price to earnings ratio by itself will not mean much, but when you club it together with ROA that we discussed earlier, it becomes very, very powerful. And these two parameters alone actually are sufficient to come up with a very good list of stocks. But in the screener, we'll see a couple of extra parameters to give us a wider safety net and to look at and to rule out some of the other problems that can happen only with these two parameters. One thing that I want to again call out before we proceed further is that do not use these parameters alone. Okay, the reason is a lot of people only look at P2E, and if you're only looking at P2E, yes, you will definitely come up with companies which are cheap. But then you will, if the reason for the company to be cheap is that it is not a good company or the business is declining right now, then you don't want to invest in those kind of companies. That is why this needs to be clubbed with ROA, because if the company is on a decline, that means their market share, they're losing their market share, they're losing sales, then with that the ROA cannot stay high, right? So ROA has to be high, and along with that the P2E has to be low. If both conditions are met, then and only then we know that the company is generating returns and also it is available for cheap. If you just look at a low P2E, that can very well be a company which is actually not a cheap company, but where, because price to earnings has earnings as the denominator, right? So the price, if it falls down, with E being constant, then P/E is going to be low. But we don't want to pick up companies where company is not doing well, and that is the reason why the company is trading at a discount. So I think this point should be clear by now, that don't use P/E in an isolated way. You need to club it with ROA to understand the overall picture. Now let's head over to the actual Finviz platform. So we'll key in the parameters on the screener itself, and there we'll see, let's see what list of stock comes up, and we'll analyze it there further. So this is the Finviz platform. I'll leave a link to this in the description for those of you who are new to this platform. And once you're on this platform, finviz.com, you basically click on the screener, and this is divided into four tabs: descriptive, fundamental, technical, and all. So I basically go to all, although we are going to primarily see the fundamental screener using Finviz here, but I like to select all, because on one screen then I'm able to key in all the parameters. So first of all, we need to develop a framework. Now what mean by framework is that there are certain rules which are always applicable, and those settings I do first, then I'll get into the specific fundamental screener. So the first setting I'm going to do is I want to look at only companies which are based in the US, and the reason for that is very simple. With the current market conditions, uh, rest of the companies are not doing very well. Lot of companies which come up here are Chinese companies, and China is doing a lot of crackdown right now on the tech sector, so I want to exclude those companies. And also I don't want to look at the European companies because their markets are not doing very well. So I right now want to focus only on the companies that are having headquarters in the United States. The next thing is I don't want to look at very small companies, so I'm going to select companies which are having a valuation market capitalization of at least $300 million. Now, if you watched my other videos, I use this other option which is over 2 billion, but in this case, I'm using $300 million, and the reason for that is uh, the first thing. Why do we put this market cap restriction? Is that I don't want to deal with very small companies, because very small companies, their stock prices are usually very volatile. Secondly, they lack liquidity. Okay, so we want to stay away from those companies. We want to look at undervalued companies, but at the same time we don't want to look at companies which are so small that their income and other operations are not very significant. We want to look at the next big market players. We don't want to basically go into the micro caps which are very small and highly volatile. So because of that, I'm using this. Now, as I mentioned on my other videos, I use $2 billion. Here I'm using 300 million, and the reason is because the entire idea of the screener is to pick undervalued companies, right? So undervalued companies would be, let's say a company was valued at $1.5 billion dollars, and right now it's trading at a 50% discount. So automatically that company is going to be having a market cap of $750 million right now. If I put the filter at $2 billion, those companies which are actually above $1 billion companies but for some reason are trading at a discount right now, I will miss out on those companies. So this filter, bringing it one step down to pick up companies which are having a valuation more than $300, makes sure that I don't miss out or drop those companies because of the filter. So this is one setting. Then I usually deal with options. So if you are also dealing in options, you want to carry out option trades on these undervalued companies, then you can put this filter optionable. Right now I'm not going to put this because we want to see the overall universe of stocks that comes up. And finally, in the framework itself, I'm going to put the average volume over 200k. Again, if you've seen my other videos, I use a volume of 500 k shares. Here I'm using 200k because these companies, when they become overvalued, sorry, undervalued, what happens is that for some duration, the volumes can go down. So let's say a company has taken a hit, and for the last couple of months, it's trading at a discount, or even last couple of weeks, then the people, most of the people who want to invest or trade in those companies, they'll be sitting on the sidelines trying to see what's happening. Is it going to go further down? Is it going to go up? So when people are sitting on the sidelines, especially people who base their trades on technical analysis, if they are waiting for certain patterns to form, during those periods the volatility goes down and the average trading volumes also go down. So with 500k, companies which are actively being traded, yes, they'll pop up. But again, similar to the way I brought the market cap a notch down from $2 billion to $300 million, I am bringing this a notch down so that I just don't miss out on good companies just because of the current volumes being traded. Okay, so definitely we'll do more analysis once the shortlist is available to us. We're not going to just go and invest into it right away. And the kind of investment that retail traders do, if 200, even if the shares, 200,000 shares are being traded, that's enough of a volume for most retail traders. I mean, if you're trying to buy 1,000 shares also, you're just doing 0.5% of the daily volume, which is not high. So this figure should be okay. So till now we've set the framework now, and remember you can set this options thing to optionable. Then only those companies which have options chains associated will come up, and those companies which do not have options will get dropped. So this is up to you. I'm not putting this right now, but you can do that if you want. Now let's start setting the fundamental filter. So I mentioned ROA. So ROA, I'm going to put more than 10%. Again, I usually like to put an ROA of more than 25%, but I like to start with 10%. So I'll see how many companies get listed. And let's say if 25, 30 companies get listed, I take a glance at it, I look at them, and then I can further narrow down by making this value more tight. I can put it to 25% and then lesser companies would come up. But for starting, I'd start with 10%, and that is return on assets, which I just explained in the slides some time back. Then next thing is price to earnings. This also we discussed. So I look for companies which are trading at a price to earnings of less than 15. Now again, the reason I mentioned and I explained these values is that you need to understand these values in the context of really what's the market condition. So if the market is in a very very bullish run, right, then you need to select P2E less than 20, because most companies, even though they are good companies, will become expensive. They will have P2E ratios which are way higher than what where they should be. So you have to adjust these parameters accordingly. Most of the times under 15 is going to give you good results, but uh, I mean, if you see the markets are in a really bull run, or if you see very few results coming out, you can tweak these values to somewhere around 15 to 20, but definitely not more than 20. And whatever value you look at, always make sure that you're looking at the P2Es of the competitors. So if you, as I mentioned in the example, right, if you're looking at a pharma stock, the one you're interested in, and P2E is 17, and you're getting confused, is 17 good? Because in the screener it was shown that the P2E should be less than 15. No, that's not the case. If the market is in a really bull run, or if this sector in particular is on a bullish run, then even a 17 PE could be a discount. What you need to do is you need to find 5 to 6 competitors, maybe 10 competitors for that company, and see their P2Es. If they all have P2Es, let's say in excess of 30, then definitely this company which you picked up with a P2E of 17 is trading at a discount. So P2E is a kind of a relative thing. You can use it to compare, and you need to adjust it based on the market conditions. And this brings me back to the point once again, that do not use, there's so many parameters here, right? If I go to the fundamental tab, you will see so many parameters are available. Do not, please do not use parameters that you don't understand. Don't use ratios that you do not understand. Stay away from them. Just because somebody is putting and using those ratios in a certain book or on a certain video, do not follow them. First try to understand what that ratio means and how it picks up the stocks, how that ratio is derived. Only if you have an in-depth understanding, then use those ratios. Because if you use ratios which you don't understand, you will drop good companies. And secondly, you will not know how to adjust the ratios according to the market conditions. Now I just explained one thing, right, that price to earnings can be, for the same company, could be under 10, for the same company could be above 15 based on market conditions. So you can compare it relative to the competitors to see where it's standing, right? So you have to have this kind of understanding. You need to be able to adjust in your mind whether this value makes sense or no, because you can see here, right, low is said less than 15, but there's no dictionary which says anything below 15 is a low P2E. Okay, in certain market conditions, things below 10 will be low. In certain market conditions, things below 20 will be considered low. So that adjustment you need to do, and you'll be able to do that only if you have an in-depth understanding of what this ratio means and what we are trying to gauge using this ratio about the underlying company. So I hope that point is clear. So let's proceed. We put in the two most important things that I like to put. Now, one more thing that I want to see, besides these two main parameters, is whether a particular company has had sales growth. So we don't want to see companies. Now, the reason why I'm introducing this parameter is return on assets will tell you what kind of returns the company is making. Now, I don't want to see a company making returns because it's selling off its assets. One way you make returns is that you start selling off your assets, right? Your assets number keep going down, and whatever money you are generating is going to come in as incoming income, right? So that is a bad way. We want to filter out those companies. So what we basically want to see is, are the sales of the company going up or not? That means the operations of the company, the core business of the company, what kind of sales are they generating, and is it growing up or not? So that is here, sales growth over the past 5 years, and again I like to put it over 10%. So now you can see that we are down to 37 stocks. Only 37 companies are there which are satisfying all these criterias right now. And sales growth is very important because sales forms the basis for the earnings of a company. So we don't want to basically see just the cash coming in. We want to make sure that the cash is coming in through the right channel, which is sales for a company. Next thing is, I also want to see the EPS growth for the past 5 years to be over 10%. Now, why is this important when we already have ROA over 10%? Is because ROA is going to tell you, based on the overall assets, what returns or earnings the company is generating. But as I mentioned earlier, there could be a reduction in assets, right? We don't want to see an ROA increasing because assets reduced. We want to see an ROA increase because earnings increased, right? So sales increase, the EPS increase, and ROA increase. All three things basically tell you that the company is on the right trajectory. To put it in simple words, these three parameters along basically these three parameters, the EPS growth, the sales growth, the ROA, will tell you that the company's operations are doing fine. They are generating good amount of returns, their sales are growing, their earnings are growing, and the P2E tells you that this company is trading at a discount. So this is how you use the fundamental screener. We just don't want to pick up good companies, we also want to pick up good companies which are trading at a discount. So these three are basically going to take care of the good company part, and this price to earnings is basically going to take care of the undervaluation. So don't just use price to earnings, and I hope by this time it's clear why P2E, using P2E alone is a very 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 bad idea. So this is the screener, and now you can see we are down to 34 stocks. Now two more things are optional, which you may or may not do uh, on the screener, and that is to basically protect against any kind of liquidity issues in the company. Although when you set these parameters, there is a very rare chance that these companies will run into liquidity or bankruptcy issues. But if you want that, then you can basically use the current ratio. So current ratio is basically, as you can see, it's a liquidity ratio that measures a company's ability to pay short-term obligations. So if current ratio is greater than 1, that basically means that this company has enough liquid assets or cash at hand to pay off its debt, which is due in the next 1 year. So with that, you basically know that at least for 1 year the company is safe. It has enough cash at hand to pay off its debt. If you want, you can put this. I usually don't put it for the simple reason that what happens is these companies which have such a high ROA, through their sales, through their operations, they will be generating a lot of cash. So that cash is still to come in, right? So many times these companies will structure their debt payments, interest payments in such a way that they offset it against the cash which is coming in. So this you can put if you want, and that will basically be a much safer output. But for now I'm dropping this parameter. If you want to be super safe, then you can basically set this as well. Then in that case, you know, right now the company has enough liquidity or enough cash to pay off its debt for the next 1 year. It doesn't have to depend on any of the revenues coming in from sales that it's going to make in the next 1 year. Okay, so we have 34 companies getting listed here, and then you can go to the charts and basically quickly take a look at the charts. So I usually look at the weekly charts to basically see which charts make sense to me, and at a glance I can basically look at multiple companies. And so most of these companies that are getting listed here are undervalued companies. They are good companies. I am not saying that this screener is the holy grail, so you don't have to do any further analysis. We'll cover that in a bit as to what else you need to basically check on these companies. No analysis is complete in itself, okay? Because for somebody who says, I just look at undervalued companies and invest, fine, that's a fine approach. But you can improve your odds of success if you also start looking at charts and do a bit of technical analysis. Similarly, for people who are pure technicians, if they start looking at the fundamentals of the company, I believe they can improve their odds of success. So this is the overall screener, and one thing let's do here is that I am going to select this uh, target price as above price. So now from 34 we have 29 stocks being listed here. So this is what we have come up based on our screener. And if you look at analyst recommendations, right, buy or better, if I select this, let's see how much this reduces by. So only two stocks are going off, right? That means based on this screener, whatever companies we selected, 27 out of those 29 companies, the analysts also feel that they have a buy or better recommendation. Let me see how many have hold or better. So it's all 29. So you can see here, right, we are on the same track that the professional analysts are. Do you understand that? Because I just put the setting analyst recommendation as hold or better, and if I remove this, the number doesn't change. This number of companies that are coming up in the output is the same. So essentially what this means is that any company that my filter or my screener says is doing well, it basically is not on the negative trajectory. The same thing is what the analysts are also saying. And if you just want to look at the buy and strong buy recommendations, then 27 out of 29 companies are in line with the analyst recommendations. So the professionals sitting in big companies doing tons of research, basically they are coming to pretty much the same conclusion that we are coming up with the simple filter. And that is why I keep saying again and again that trading is all about keeping things simple. Investing is not tough. When you make investing overcomplicated, that's the worst thing you can do to yourself, because too much information, nobody can understand it. It just looks hi-fi. It looks, if people are using big terms and they're saying, you know, ROE is this much, return on investment was this much, the internal rate of return was this much, the CAGR was this much. So all these things, they sound good, but then as long as we keep our analysis simple, that is what is the most important thing. And this basically itself is a proof that I selected let's remove the target price as well, okay? Because target price is anyway set by the analyst. So I came up with 34 stocks. This filter, simple filter here, came up with 34 stocks. And if I go to analyst recommendation, hold or better, that is for 30 of those stocks. So basically, if I go for buy or better, let me do that. It's 28 stocks. So we shortlisted down to 34 stocks from a total of, I think, more than 8,000 stocks were listed here initially. From 8,000 stocks, we are down to the 34 good companies that this screener was telling you to invest in. And the analysts feel, I mean, 28 of those recommendations out of 34, the analysts are in line with us. They believe in the same thing that we believe in. And I already said that this is only a screener. we also have to look at other parameters about these companies to make sure that there is nothing wrong with the companies. They have enough, they're not having any serious litigations running against them. They have no risk of bankruptcy. So I'm going to cover this in a bit. But then probably we would have dropped those companies as well because of genuine problems that we see around those companies. So this itself, I mean, I'm very happy with the numbers here. I think this itself speaks for the quality of the screener, that the professional analysts, so-called analysts charging hundreds of thousands of dollars for generating these so-called analyst reports, are coming up with a certain set of stocks, which is 28 in number, and our list was 34. And so we are basically getting 85% of the results that the analysts were giving us, and that is fantastic. So this screener, I mean, this particular thing that I just showed you, that whatever stocks we shortlisted, the analysts are kind of in line with us. That basically confirms the fact that investing is not difficult, and you don't have to depend, or you don't have to think that somebody sitting in a big office is doing some kind of extraordinary research which you cannot do sitting at your home, and you cannot have the same advantage as a retail trader that the professionals have. Okay, because the financial statements, right, the balance sheet, the income statement, the cash flow statement, the same values are available to everyone. The public information about a company is same for everybody. So fundamental analysis really evens out the stage for everybody, because nobody has advantage, nobody has information that only they have. It's public information. Go through the 13F filings, and look at the balance sheets, the cash flow statement, look at the investor presentations to see what the company is projecting. Is the product good? Research the sector as whole, and you can basically come up with the same kind of analysis that the professional analysts are doing, and with a pretty high accuracy. And also, we know that the analysts are not correct 100% of the times, right? So with that in mind, I think these results look good, and you can use the screener. Now, before we close the Finviz screener settings, one more thing that I want to call out is that now 28 stocks are coming up, right? Let's say I don't want to look at 28 stocks, I want to look at 10, 15 stocks. Then I can keep tightening the values here. So I can, instead of looking over 10% ROA, I can start looking for over 25% ROA. These are really good companies. And now you see I'm down to 7 companies. So these 7 companies satisfy all the criteria, but they are giving a really high ROA. So I can start my analysis with these 7, and then let's say I don't find enough investment opportunities, then I can just bring it to 20%. So more companies will come in. Now I have 9 companies to work with. So as long as I don't find enough companies to invest my capital, I can just keep playing with these values, tightening these values if I want to look at a lesser number of companies, and easing out on these values if I want to get more number of companies. So now let's get back to our presentation, and we'll cover some of the final points before we close the presentation. So we already went to Finviz and we saw the actual screener settings in action, and this is critical. This is key. I've already mentioned this, that in mathematics 2 plus 2 is 4, but when you combine the power of fundamental analysis, technical analysis, and SWOT analysis, that basically creates synergy. So 2 plus 2 plus 2 is no longer 6, it becomes 60. Okay, and that is the power of synergy, and that's what you should try to create with your trading or investment. So essentially, if you just use fundamental analysis, or if you just use technical analysis, that is not enough, because it's I don't like analysis paralysis. So instead of looking at only fundamental analysis and using 20 ratios, I would suggest look at the most important ratios in fundamental analysis, and the rest of the time that you're devoting to explore those additional ratios in fundamental analysis, do a basic technical analysis as well, because a combination of these two, basic level combination of fundamental and technical analysis, will yield much better results than an in-depth analysis of either of these disciplines. Because there is a lot of trading which happens on fundamental grounds, there is a lot of trading which happens on technical grounds. So we need to take advantage of both these disciplines without making either of them overcomplicated. And the third thing, which we did not discuss till now, the risk and threat analysis, is what I'm going to discuss in more detail in a bit. But this is more about understanding that even though a company looks good from a technical analysis point of view, from a fundamental analysis point of view, there can be some hidden risks which are not evident. So we need to do some more research before we make that trading or investment decision. And this is basically the don'ts page. So I've already mentioned this. Do not use ratios that you don't understand. If you want to use some ratio, please try to see what that ratio means. And I just don't want you to look up the formula that so and so ratio is this value divided by this value. Understand what is the source of those values. How do those values change? Is it an increase in sales? Is it a decrease in sales? What kind of message is that parameter giving you, right? So that is key, because if you just see a value, you are not going to be able to interpret it. And don't use it like a robot that the value should be less than 10, less than 2, less than 1. No, it doesn't make sense. I just showed you that the quick ratio, which basically means is the company having enough cash to meet its within 1 year due debt obligations. I'm not worried about that. Why? Because I'm looking at companies which have a 25% ROA. So a company which is generating 25% returns on its assets is definitely going to be in a position to pay off its debt based on its uh, inflow of income. So those companies can afford to have that kind of debt, and in fact, they may be managing their installments in a very nice way that they are not keeping any cash unutilized, right? So you have to get deeper into it. Just by knowing that this ratio should be less than this or more than this doesn't work. So don't use ratios which you don't understand. The next thing is, don't use too many ratios which use the same underlying data, because then you're duplicating your efforts. If you looked at the screener carefully, you can go back to Finviz and you can see it. There is a parameter called return on equity. There is a parameter called return on investment. Okay, so now return on equity, return on assets, return on investments. Yes, there are different calculations in terms of the formula, but then they are going to be correlated. Companies which have high ROA will eventually have high ROE as well, because the returns are going to be the same. The denominator in one case is the overall assets, on the other case, it's just the equity, and assets is equal to the equity plus liability. So I mean, with that equation, you can understand, right? If ROA is high, ROE is going to be relatively higher. So values may be different, but there's no point using ROA, ROE, and ROI all three in your analysis. ROA is enough. So just because you're using 10 parameters, but all 10 of them directly or indirectly are being derived from the same underlying value, doesn't make sense. This is something which I keep telling. I have a complete video on do technical indicators actually work, and I keep telling this point across that technical indicators are nothing but a calculation on the price or the volume. There's only two sets of data which comes out of the stock exchange: price and volume. So you can apply 20 different formulas and create 20 different indicators, but end of the day, all of them are looking at the same price and volume data. So when the underlying is the same, how different can the results be? Those indicators are not going to generate any magical information, because all of them are using the same set of data, price and volume, right? So same way in fundamental analysis, these ratios, you can have tens of ratios, but if all the ratios are looking at the sales figures, or all the ratios are looking at the earnings figures, they don't make sense. They basically, if one ratio is high, other ratios are going to be high. Yes, the values may fluctuate a bit, but they are going to be high, because the underlying data from the balance sheet or from the income statement or from the cash flow statement is the same. So that's the reason the first point here is very, very important. Please do not use ratios which you do not understand, because when you understand ratios, then you'll immediately be able to figure out, you know what, these two three ratios are just one and the same thing. I'll use one of these, I don't have to look at the rest of them. That simplifies your analysis, and it takes off that confusion. Okay, I saw a high ROA, but the ROE is low. What does it mean? No, I'm just going to use ROA because ROA and ROE are kind of related. With that, I think I have covered most of the details. Please make sure that you just don't use the screener output and start buying stocks. You need to do your due diligence. Make sure that you're checking that there are no other risks with the company. The company is not going to get bankrupt. It doesn't have any litigations going against them. The company is not in a business where it will lose its edge in some time. Let's say some company is getting a huge amount of revenue because of the patents it has, and you know that the patents are going to expire in the next 1 or 2 years, then that is not a long-term investment, right? It's going to lose its edge. So we don't want to invest in those kind of businesses. And the third thing is fundamental analysis is usually for longer term trading. Okay, because the market can realize that the current market value is way below the intrinsic value within a month, or it may do it in the next 5 to 10 years. There's no reason why the market should correct itself within the next 10 days or 15 days. What's important here is that if you are doing the if you're selling naked puts, as I have shown in a lot of my live trades, which is what I do most of the times, then if you're doing those kind of trades, if you're selling naked puts on fundamentally sound companies, then even if you own the shares, you know that now you're owning shares at a very deep discount, because these companies were already having, they were undervalued, they had a high intrinsic value, low market value as compared to the intrinsic value, so they were highly undervalued. And now because you sold a put, you have received shares of that company at an even lower value, that means at a very very deep discount. So that gives people the confidence to hold on to their shares and believe in that position. So I hope with this, the screener settings, fundamental analysis becomes a bit more clear to you. And as usual, I hope this you like this video. If you did like this video, please subscribe to the channel. I have a very low percentage. I think only 20% of the viewers who watch my videos are actually subscribed to the channel. So it just takes a second. Please subscribe to the channel if you like the content, because that gives me a direct feedback that I should continue creating this kind of content. Like the video, please share it with your family and friends if you find it helpful. And also, if you have any queries around this, or if you want more information, more videos, or you want me to pick up actual companies and analyze them and explain how I arrived at those companies, please leave those in the comments. I'll definitely respond to you, and I'll also, if needed, I can explain any other concepts that you want over another video. So thank you for your time, and I'll catch you guys in the next video. Bye bye.